This week, it's our first time with a finance specialist, Shaun Weekes. He's here. Over a decade of experience in mortgage and getting people solutions to their finance. This is a question a lot of people have been asking. How do I finance my ADU? How do I get this project started? Banks don't seem to know what I'm talking about sometimes. And Shaun speaks the secret language of underwriters. So over to you, Shaun.
Hey, thanks a lot, Ryan. I'm really excited to go ahead and give some information and basically give everybody some knowledge on how to, use the cash, use the equity in their home, turn that into cash and go ahead and finance their projects. A little bit about myself. I've been in the loan business for 17 years on the sales side and also on the processing side. So I'm very well versed when it comes to the whole process, the whole mortgage process, basically from A to Z. I've done over 3,000 loans in that 17-year period. I'm an expert when it comes to conventional financing, FHA financing, VA and jumbo loans as well. Today I'm just like I said before, today I'm just here to talk about how to do a cash out refinance on your home, or the home that you want to build the ADU on. So whether it be your primary residence or an investment property, we can talk about that, and I'll get into some examples with that a little bit later as well. The first thing a loan officer looks for in their client or their borrower is something called CIA. I coined the phrase CIA, credit, income, and assets. Anything over 700, 720 is pretty much considered AAA credit. Anything over 680 will qualify you for a jumbo loan. There's obviously exceptions, but that's kind of the baseline for that number. So after you figure out what the credit is, you move into the income. The way we look at income, there's a couple different ways to approach it. You have your W-2s, obviously, and your 1040s, which are the IRS tax return. So I have a question here. What is considered a jumbo loan? Okay, perfect. Let me back up. It depends on what county you're in. So let me give you an example. I live in San Bernardino County out here in California. Anything loan amount wise above 510,000 is considered a jumbo loan. So let me give you a quick example. Say in my city over here, I live out in Rancho Cucamonga. So say there's a house that's selling for $800,000 and I want to put down 20%. That's 160,000. So my loan amount is going to be what? 640,000, I believe. So that would be considered a jumbo loan in San Bernardino County. But if that was in Orange County or LA County, it wouldn't be considered a jumbo loan because their loan limits are higher. Their loan limits go all the way up to, I believe it's 765, roughly. And that's for a 1-unit property. It moves up in increments. If you have a 2-unit property or a 3-unit property or a 4-unit property, you're getting up to, in some counties, up to 1.4 million. So so a jumbo loan is basically a loan that is higher than the conforming loan amount per your county. Maybe what I can do is I will give Ryan some information that he can post on his website, and you can look up what it is in the different counties. You're very welcome. So the income, W-2 income, 1040 income, those are for, W-2 is for a wage earner. If you're self-employed, you might have a corporation, an LLC. You could also be a sole proprietor under Schedule C. All that information is going to show up on your 1040s. So a good loan officer is going to ask for 2 years of 1040s, 2 years of W-2s, and 30 days of pay stubs. Again, if you're self-employed, I might ask for some type of P&L, profit and loss statement. So that's kind of how we, obviously there's more calculations I'm not going to get into. That's what you pay me for. but that's the information that needs to be gathered from an income standpoint to go ahead and calculate the income. Finally, there's assets. Assets can be cash in the bank. It can also be 401k, IRAs, anything like that to show assets. When you put those three aspects together, credit, income, and assets, if you are very good on all three, you have an extremely good chance at getting financing. If you have 2 out of 3, you still have a pretty good shot. And if you have 1 out of 3, that's when it becomes more difficult, and you have to use portfolio loans or private money and things of that nature, which I'm not going to get into much to today. Another example that I wanted to give was, that's a good question. Does your home equity count as an asset? It does not. There are asset depletion type loans, but those asset depletion loans are based off of liquid funds. Funds like, bank statement, funds like a 401k that you can draw off of. The equity in the home won't count as an asset, but the good thing about having a large amount of equity, let me give you another example. Say you have a home that's worth $1 million, and say you only owe $200,000. Your loan to value is 20%. Say you need $300,000 to complete your project. That's $500,000 loan amount. That is an LTV of 50%. That is extremely low, which means it's really good. For an owner-occupied property, when you get up to the 80% mark, that is, the higher the LTV, the higher the rates, right? So for cash out, you can go up to 80%. In some cases, you can go up to 90%, depending on, your FICO scores. But to answer your question, the equity in your home, it is an asset. It's just not considered an asset for grading purposes for Fannie Mae and for Fannie and Freddie. But, it is a huge asset. So that kind of actually, brings me to my next point, which I was going to talk about the loan to value. I already kind of gave an example of that. Your LTV is going to be definitely a deciding factor. Anything under 60% is excellent. LTVs go up in increments of 5%. So 65, 70, 75, etc. Every time you move up in a 5% increment for LTVs, you're going to see your rates steadily increase. Right now, rates are at an all-time low. So, you can easily go ahead and get something, at an 80% mark, if it's an owner-occupied property, and still have a rate in the 3s if your CIA is strong, right? So that's a great thing and an advantage if you have that. Some of the documentation that you'll need to go ahead and complete a cash out refinance are as follows. Your loan officer is going to ask you for 2 months of bank statements. They're going to ask for, again, assets like a 401k, IRA, an annuity, anything that shows some type of cash value. Also, they're going to ask for 30 days of pay stubs if you're a wage earner. If you're self-employed, they will go over a P&L statement, a profit and loss statement, 2 years of your tax returns. So this is a really weird time we're in right now with the coronavirus going on. So the IRS kind of did something that I've never seen before. They actually extended your taxes to July 15th. So a lot of the clients that I'm dealing with right now haven't even filed their 2019. It should have been done April 15th, right? But what I'm seeing a lot is 2018 and 2017 tax returns, which is fine because it's not due yet. Also W-2s for the past 2 years. And when you fill out a mortgage application, you also want to give history of employment as well. So they're going to ask you, what your job title is. They're going to ask for your HR phone number so they can verify your employment. They're going to ask you, how long have you been in the position for? I've been a histotechnician for 20 years, and I've been working for, Kaiser Permanente for, 15 years. I don't work with Kaiser at all. I just threw out that name. Okay. Just want to say that out there. But so that's the whole credit, income, assets. That's all the documentation that's needed to move forward with a refinance. Next thing in the process would be the appraisal. The appraisal is going to be a opinion of value based off comparable sales in your neighborhood. If they can't find comparable sales in a neighborhood, you can move out of the neighborhood. But, you know, hopefully you have comparable sales that are anywhere from 1 to 3 months old. That's the best. Next would be 3 to 6. And then after that, they'll actually move into different neighborhoods to try to keep those comparable sales within that 3-month period. That's typically what underwriters want to see. They can go up to 6 months, but you know, the closer the sale, the better the comparable. The better the comparable, hopefully that comparable, it was also $1 million, and it'll help with obviously the value of your property. Once the appraisal is done, the underwriter will go ahead and, you know, put all that information together, your credit, your income, your assets, all the documentation, the value of the property, and they'll go ahead and, you know, solidify the approval that you already got through Fannie or Freddie Mac, Fannie Mae or Freddie Mac. Let me back up for a quick second. When a loan officer collects all this documentation, they will go ahead and put it into a mortgage application, and that mortgage application will be run by Fannie Mae or Freddie Mac. Fannie Mae has something called Desktop Underwriter. It's an automated underwriting system, and that will spit out approve eligible, refer eligible, refer with caution, or just ineligible. So if you get that approve eligible, that is Fannie Mae saying, look, we will buy this loan from whatever bank you use to, you know, to get the funding. And all that information, that's why we ask for all this information, because we just, you know, copy it into their system, pre-populates the approval. Then the underwriter looks at that automated underwriting system approval, and they'll generate other things. They'll say, hey, I want to verify your pay stubs. I need to verify the tax returns. They do that by, I won't get too much into that, but they have something called a 4506T, which is an IRS document that verifies your transcripts to make sure that the 1040s that you're supplying me are, you know, the actual 1040s. So after they do that, the bank will actually issue you an official approval, and the official approval will have different conditions that the processing department has to take care of. Now, typically it's out of the loan officer's hand at this point, and typically it goes onto the back end. So if you remember during the introduction, I said I have experience on both ends of the field. I actually process a lot of the loans that I do as well. So the advantage to that is I understand exactly, you know, what it is that you're looking for and what it is that you need. Once the approval process is completed, there's certain waiting periods and disclosures that are associated with the loan. Typically, you know, it'll take anywhere from 2 to 4 weeks to get the whole process completed, and you'll get that cash that you're looking for to you know, move forward with building you know, building ADU. You know, one thing that I was speaking to Ryan about earlier actually was, you know, if you already have, like, say you don't have any idea how much something like this is going to cost. You want to work backwards, right? So you want to, you know, use the tools that How To ADU offers in order to find out, you know, how much a, you know, 500 square foot ADU might cost. And, you know, on his website, that information is there for you to kind of figure it out. And then at that point, you know, you can come to somebody like myself and say, hey, I have a property that's worth $1 million. I owe $400,000. I know my ADU is going to cost $200,000. So I want to get a cash out refinance for a total of like $600,000 or $650,000 or something like that. Another point that I didn't talk about, just so that you know, everybody understands the process, is, you know, in that scenario, if you owe $400,000 and you want to get a loan for $600,000, the new lender will pay off the $400,000, so your old loan will be all paid, and then you'll have a new lien on title, for $600,000. That extra $200,000 will be paid to you through escrow. Escrow and title is a third-party process. If somebody approaches you and doesn't use title and escrow, that's a big red flag, right? So, you know, you want to use title and escrow, and they will direct deposit the money into your account if you provide them with a canceled check, or a canceled check, or a route number and account number, or they'll just do it the old-fashioned way and mail you a check, FedEx you one if that's what you'd like as well. But yeah, that's basically the whole process. There's a lot of different ins and outs. There is something that I want to talk about specifically for ADUs. You have to have, you can't, if you have a duplex or you have a triplex or you have a quad, Fannie Mae and Freddie Mac will not lend on that property if there's an ADU there already. So it has to be a single family residence if the ADU is already present, okay? If the ADU is not present, sure, you could get money out of a duplex, a triplex, or a quad, but just know that it's going to be much harder to finance that after the ADU has been purchased. You're going to need maybe a commercial loan, maybe private money, or maybe even a portfolio loan. A portfolio loan is, if you go to a local bank, a portfolio loan will be them lending their own money. It's not a loan that they will sell to Fannie or Freddie. It's a loan that they will keep in-house. So obviously, if they're lending their own money, the fees are going to be a bit higher. So that's something that you want to definitely keep in mind. A single-family residence will be the easiest way and the only way to finance an ADU if it's already on the property. That's basically the whole financing process. Obviously, it's different for FHA or VA or conventional or jumbo. Those are specific things that you might want to ask questions about now, or that I can help you with at a later time if you have those types of questions. Anything you can think of, Ryan, that you want me to speak about a bit more here?
I think one of the things that triggered our conversation to begin with in this webinar is rates are looking pretty good over the past. Everything's changing every week now, but there have been some really good rate opportunities, and I think you've highlighted on a cash out refinance, you do two things at the same time. You get a bunch of cash out of your asset, the house, right? And that lets you build, but it also gives you the potential to lock in a new rate. Have you seen, or do you have a gauge on where rates are at right now and what? Sure.
I typically deal with a lot of investors. So I do a lot of investment property type refinances. And, what I've been seeing by processing these loans on the processing side of everything, I'm seeing rates for investment properties kind of in the, high threes, 3.875, 3.9, 4%. And for owner occupied properties, I'm seeing rates, as low as 3.25, 3 1/8. That's for conventional financing. For FHA and VA loans, those government type loans, I'm seeing, rates. Well, first of all, FHA can only be for owner occupied. Somebody just asked about a 15-year mortgage. I'll get to that in a second if that's okay. For FHA and VA, they're looking in the high twos, maybe 3%. But obviously for VA loan, you have to be a veteran. FHA loan, it has to be owner occupied. It's not for investment properties. Jumbo loans, I haven't done a jumbo loan for a while, to be honest with you. But I see the rates every day for jumbo loans, and those are hovering kind of in the low 4, mid 4% range for jumbo loans. Back to that question for a 15-year fixed. 15-year fixed, and again, with this coronavirus thing going on, it's really weird. I'm seeing 15-year fixed rates actually a bit higher than 30-year fixed rates, which is kind of weird. So for owner occupied 15-year, I'm seeing stuff in the mid threes, 3.375, 3.625. Yeah.
Are there ways to take a 30-year but pay it off faster so that it works like a 15-year?
Right. I was just going to get into that. So another way that you can work around it, and this is what I would recommend, because especially in times like this, if you are stuck in a 15-year payment, that's the payment you have to make. And that payment's going to be, let's just say that your payment's $2,000 on a 30-year. For a 15-year, all things considered, that payment is probably going to be in around the $2,900 range. So what you can just do with a 30-year is literally just pay the additional, $800 per month. Make sure that your lender knows that you're paying that towards your principal, though. You don't want that to go into your escrow balance. I've seen it before where their escrow balance just increases and increases, but it's not going towards the principal. So just make sure you're clear with your servicer. Hey, I want to go ahead and pay an extra, $500, $600, $700, $800 a month, and I just want to make sure it's going to the principal, and they will be completely fine with that. There's no prepayment penalty for the most part on well, there is no prepayment penalty for conventional loans or VA or FHA loans as well. So yeah, in order to circumvent that, that process, just pay more on that 30-year loan. If you really want to do the 15-year, sure, you can. But right now, it's just kind of weird. The interest rates are a little bit higher with that number. I'll have more information on that if you want to reach out to myself or whatnot. We get rate sheets every morning around 7 a.m. So feel free to send me an email.
That's a good segue. I'm going to put in the chat a link to book a session. You can get a free one-on-one with Shaun if you've got questions about your property and you want to start moving forward on a loan application. I'll put a link to that in the chat. I'll also email one around to everybody after the session. And that'll be a great way to book a time so that Shaun can call you and answer some of the more nitty-gritty questions.
Right, because that'll be specific to your specific scenario. So we can figure that out in that half an hour to 60-minute period for sure. Any more questions out there? Don't be shy. You're welcome.
What were some of the things we were talking about beforehand where customers have been asking, they've been writing in some questions like, are these, can you use the rental income that you expect to get toward the loan, or are there rules around that?
Right, so there's definitely rules around that. There's 3 different scenarios. Fannie Mae actually just passed, thanks for reminding me, I should have brought this up earlier. Fannie Mae just passed, in their seller guide, a new rule on rental income. So on April 1st, they said that you have to have a year of experience in order to use the rental income towards your income. So let me give you a scenario here. Say that you make $5,000 a month. You make $60,000 a year, okay? And say that your mortgage payment is $2,000, and say you have another $1,000 in debt that would show up on your credit report, maybe a car payment and credit card payments. So now you're at $3,000 per month in debt payments, and you're at $5,000 in income. Your DTI, debt to income ratio, is at 60%. That's too high. Well, maybe for a VA loan, that might be okay. But for all other types of loans, that's too high. So what people have done in the past is they said, okay, look, that $2,000 payment can be, okay, let's say the rental payment was $3,000 for that house. So I can use 75% of the income towards my monthly income. So I think 75% of 3,000 is what, about $2,250, I believe. So now I can use, if I have a year of experience, I can use that $2,250 towards, everything else. So now instead of making $5,000 a month, I'm making $7,250 per month. So now my debt to income ratio off 3,000 is let me do the do the math here. I'm making these scenarios up. These aren't pre-populated scenarios. So let's do it for you here. 3,000 divided by 7,250. So your debt to income ratio is now 41.3%. That is acceptable. That's an excellent ratio. So in the past, that's how we do the calculations. Now it's changed. If you have a year of experience, great. You don't even have to worry about this. If you own a home, but you don't have a year of experience, we can use the rental income to offset the new rental property's mortgage. So in this case, I could use the $2,250 only for basically I could only use 2,000 just to, cut off the rental property's payment. And if you don't own any home, and when I say own a home, I should be more specific. If you have no mortgage obligation on your credit report, in other words, if you don't have a mortgage on your credit report, you have to qualify for that investment property based off of your income. You cannot use rental income in that scenario. So those are the three different steps. And like I said, this is new. This just came out about 30 days, 35 days ago, whatever. So that's been a challenge for newer investors who are looking to get out of the rat race, or for whatever reason they want to get a rental property. They were dependent on that rental income to qualify. They won't be able to do that, so they're going to need to get into that either with some type of cosigner or something like that. Okay, sorry. So let me see. Let me back up on the question.
Yeah. So we're being asked to clarify the three different scenarios you just went through. So if I understand, there's like I own a home free and clear. There's I own a home with a mortgage, and then there's like I'm an institution, like I rent out property. I own multiple properties.
Right. So it doesn't necessarily have to be free and clear per se, but okay. So let me give you an example. Say that I own my home, okay, and I want to buy an investment property in San Francisco, and that investment property has rents, okay, obviously, but I have no experience with ever receiving rents, but I do own a home now, and I do have a mortgage on my credit report. In that scenario, the rents from that San Francisco property, I can use those only to offset the mortgage on the San Francisco property. So if I have if I have a Ferrari and I got a $10,000 payment and I'm only making, $20,000 a month, most likely I'm not going to qualify because my DTI is going to be over the 50% mark if I'm making 20 and I'm paying out 12, right? So that's one scenario. The other scenario is I have a year experience, then it's a no starter. Like you have a year experience, you can use the rental income, no problem. The third scenario is I don't own anything. I have no mortgage obligation on my credit report. In that scenario, I cannot use the rental income towards my income. I have to qualify for that property solely on my income. Sorry, sometimes I talk too fast.
That's
that
perfect.
help you? It looks like Marta that asked that question. Does that help?
Yeah.
I think I get it now. Yeah. It just was,
okay.
Yeah. It's Sunday, so I'm just kind of.
Yeah. And I can go over that with you if you'd like at a later time to kind of be more specific.
Yeah, it's always easier to get less hypothetical eventually and start talking to each of you about your properties, right?
Right.
I think another topic that's come up in emails for people writing in was how much. Let's say they've got $1 million house and they've got $600,000 in equity in that house. How much of that can they take out in a cash out?
So if it's an owner-occupied property and your CIA qualifies for it, you can get up to for a conventional loan, you can get up to 90%. For a VA loan, you can get up to 100%. VA loans are incredible. So, a lot of veterans, look to use that VA loan. It's a 0% down payment. And also for a refinance, it's 100%. Now, when you get over 90% for a VA loan, it becomes a bit more expensive, but the option is there to take out 100% of the value. But typically, for a conventional loan, as long as the numbers work right in the county, remember I was telling you about different county limits, you can get an 80% first loan. So if you have $1 million house, well, actually, you see, on $1 million house, that wouldn't work actually because you're over the conforming loan limit. So on an $80,000 on $1 million house, you wouldn't be able to get 800 on the first. You could probably get up to about 765 on the first, and then you'd get the rest of the 10% through a home equity line of credit. There's a couple banks that do those types of combo loans. But yeah, you're looking at basically 90% if you're, if you have a 700 FICO plus or 680 plus, I believe, that bank will move forward. If you're over 720, it'll be a lot less expensive than if you're at the 680 to 719 mark. But yeah, you could get up to 90% of your home's value.
So, Shaun, you've talked about a couple scenarios other than Fannie Mae, like that one.
Sorry, not to cross you. For an investment property, if it's a single family residence, it's a 75% loan to value would be the max. And that is, that's for investment properties. Yeah. And this is all based on Fannie and Freddie guidelines. There's other banks that have portfolio loans that do different stuff. But like you said, book something and then we can talk about your specific situation, or you can even ask about it now if you'd like.
That was exactly my question is, so you've talked about a couple different scenarios that are outside of the Fannie Freddie umbrella, either banks doing combo loans with a HELOC or portfolio where they plan on keeping it, not reselling it to Fannie or Freddie. Do you know how to help people with those kinds of loans? Can you help people?
Yeah, absolutely. Now, one of the unfortunate things that's happened with this coronavirus that we're going through is there's something called NonQM loans. Those are non-qualified mortgage. When you do a mortgage under the Dodd-Frank Act, like Fannie and Freddie loans, you cannot be charged more than 3% of the total loan amount in fees. That's there to protect the client, the borrower. Now, for non-QM, that means that they don't follow that 3% rule. A lot of those lenders have completely dried up. Like from the end of March to the middle of April, a lot of them went out of business because they were selling loans to Wall Street, hedge funds, things of that nature. And those secondary market purchasers just said, hey, we don't want 2008 happening again. So at least that's my opinion. I don't know exactly why they pulled out, but that's my opinion, is they just didn't want to have a repeat of what happened, 12 years ago. So a lot of them just said, nope, we're done financing those types of loans. But yeah, to answer your question, I always look for Fannie and Freddie stuff first because those are the best rates and the lowest fees. And then from there, we can move on and up depending on what your situation is. And again, your situation will always come back to your CIA, your credit, income, and assets. Yeah.
Any other questions from the crowd? We've got some interaction from some very good interaction, and then some of you are very quiet, which I think means you need a private session with Shaun. Well, no need to draw things out. It's been a lovely Sunday afternoon. Shaun, this has been super informative, and I'm really grateful you sharing your expertise with our subscribers. If there's nothing else, I'll just say happy Sunday, and I'll send the recording out, and I'll give you guys that special link so that you can book a time with Shaun. And I look forward to hearing more about your projects and helping you get them over the line.
Thank you for the opportunity. Thanks everyone for tuning in, and we're here to help.
Thank you so much. I really appreciate you guys. Seem like you've got a lot of information, and like you're solid professionals, and I really appreciate, Shaun, the information you shared.